On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope everyone's well. Another recap episode today. I wanted to revisit a piece of work that I put together earlier in the year that I found really fascinating and that a lot of you gave me some positive feedback on. Now, every once in a while, you will hear people talk about how much worse off you'd be if you'd missed the 10 best days in a given period. We usually get those sorts of articles or messages coming through during rough patches, and the writer is usually hoping to calm investors down and keep them on track and keep them staying the course rather than seeing them panic and sell at the wrong time. So I've been in this game for a little over 20 years and I have no doubt that I've written about this particular topic myself. The numbers are always very compelling because if you'd invested $10,000 in the US S&P 500 index 30 years ago and done nothing with it, you would have $231,000 today. Maybe that's not precisely true because there would have been a few costs, there would have been some administration, there might have been some taxes, but we're just using those cold hard return numbers for illustrative purposes. 231,000 from 10 grand over 30 years, not bad at all. However, if you had missed the 10 strongest days in the market during those 30 years, just 10 trading days, rather than having 231,000, you would have just 113,000. So that is 11 times more than you started with, but it's 51% less than if you had simply stayed put. So the message here is admirable, and it's always good advice to keep your eye on the long game rather than tinkering along the way. I say that all the time to prospective investors. But even so, a point that is often missed is that the best days usually come during the roughest periods, and that means they're often in close proximity to the worst days. So the 10 best days of the past 3 decades were either during the GFC in 2008 and 2009 or in early 2020 when harsh lockdowns shuttered the global economy during the COVID period. Now, 7 of those 10 best days came within just a week of one of the 10 worst days. So what that means is, if your crystal ball was good enough to allow you to choose between one or the other, you would be much better off to avoid the worst 10 than to catch the best 10. If you'd avoided the worst 10, your $10,000 would have grown to nearly $550,000, which is more than double that of the buy and hold investor. Now that's highly unrealistic as well, because those strongest and weakest days tend to come during those most volatile periods, during those rough patches. They tend to go hand in hand, and we do see them very close together. So chances are, if you really did miss those 10 best days, the truth is you'd probably be no worse off, as you would have almost certainly missed the worst 10 as well, or at least several of those worst 10. And looking back at our previous example, missing both the best and the worst 10 days would have seen your 10 grand increase to 263,000 today. So that's higher than that stay the course outcome, but not dramatically so. We've just got to remember that market corrections, which are generally thought of as declines of 10% or more, are normal. The S&P 500 index in the US has experienced 34 of those since 1960, so on average they come about once every 2 years. Now 10 of those 34 did evolve into more painful bear markets, where the S&P 500 fell by 20% or more. The other 24 led to an average decline of about 14%, and they lasted on average about 4 months before the recovery took hold. The most recent correction obviously came earlier this year in the wake of the tariff tensions, and at its weakest point, the S&P 500 was down 18.9%. That's based on closing prices, not intraday prices. Before that, the last one came in the second half of 2023, and back then the market fell 10.3% before it bounced back again. So I'm sure it won't be too long before we see another correction of some magnitude. When that does happen, there's a good chance you'll see an article somewhere warning you about what will happen if you miss the 10 best days. Now, we know that thinking is slightly erroneous. We've proved that today. But investors should still take note of the sentiment. The author of that report, and it won't be me, they will be trying to politely remind you that timing the market is very difficult, often foolish, and that you're often better off to just sit tight and stay put. So that's all for today. Hope you found that interesting. Please reach out if you want to know more, and we'll talk again soon. Thanks for listening, team.
For more insights, visit craigsip.com.